Hey guys, welcome back to another video. In this video, I'm going to be talking about ExxonMobil, which might seem a little underwhelming right now looking at this stock price, which is down 13% in the same year that SPY is up 21%. But actually, as we'll see in this video from a couple of points that I'll highlight, ExxonMobil is actually currently presenting what could be an actual good buying opportunity. So we're going to talk about a couple of things like their business model, their financial statements, and then also just value their company using a DCF model. So first off, let's talk about their business model and how it is that ExxonMobil actually makes money. So ExxonMobil is one of the biggest oil companies in the world. They do business deals with crude oil, natural gas, petroleum products, and petrochemicals. They explore the world for these products, produce them, manufacture them. They trade these products and also transport these products all over the world. Their business operations are broken up into three primary segments: upstream, downstream, and chemicals. The upstream oil and gas segment of their business operates in 40 countries and produces millions of barrels of oil and natural gas per day through exploration and production. The downstream oil and gas segment of their business manufactures fuels and sells millions of barrels of petroleum products per day. Downstream is Exxon's largest source of revenue and profit, and the fuel that is refined in the downstream segment of their business is refined into different finished products, including gasoline for your cars, heating oil for your homes, and then also aviation fuel for our planes. Then lastly, the chemical segment of their business produces millions of tons of petrochemical products. All of Exxon's products are sold through Exxon and Mobil branded retail service gas stations, passenger and commercial vehicle businesses, and then also other global businesses to business markets. So B2B markets, and then also direct to consumer through their gas stations and also through their website. So now I want to look at this article that highlights a couple of reasons why Exxon could actually be a pretty good buy, even though, as we'll see from other points in this video, it might not seem that they are. This article touches on some of the points why they would be a good buy. So for starters, right here, they point out that Exxon recently reported their second highest year of earnings over the last decade, and there could be even more growth to come in the years ahead. Exxon's record earnings in 2022 were a bit of an outlier because oil prices surged in response to Russia's invasion of Ukraine and geopolitical tensions, leading to stronger demand, which featured. But then in 2023, after the rebound from 2022's high oil prices, oil and gas prices went back down. So that could be a glimpse of what's to come for Exxon based on the future projection of more average priced oil prices. First off, they have plenty of cash to go around. The cash flow for Exxon is very impressive. At the end of 2022, they had a cash position of about $29.7 billion. But at the end of 2023, their cash position was about $2 billion higher than it was at the end of 2022, showing that they could fund their operations and future growth and support an expensive share repurchase and dividend program with the cash that they have, which is obviously one of Exxon's primary method of getting a return back to their shareholders is by paying out dividends, or a very high paying dividend stock. Secondly, through structural cost savings and reductions, Exxon is giving themselves an added cushion for the next downturn. They have a near perfect balance sheet. They finished 2023 with a debt to capital ratio of just 16%, which is around the lowest level it's been in the last 8 years. And then lastly, right here for this video, I'm pointing out that they have a healthy capital return program. In the third quarter, Exxon announced a dividend raise of about 95 cents per share, marking the 41st consecutive annual dividend increase. Pretty impressive that they've increased their dividend for 41 years straight, which obviously is very impressive. We've seen the economy go through plenty of ups and downs, and yet Exxon has consistently paid out their dividend. And now with their cost savings, their better balance sheet, and the increase in cash that they've received, they are able to continue to support this dividend and to repurchase common stock and return value back to shareholders. So a lot of good reasons why Exxon might be worth buying right now. But now, as we see looking at their financial statement, it's going to get a little bit more grim because we're going to see the downturn that came from the outlier prices in 2022 compared to 2023. So right here, this is their income statement for the third quarter. They had $90.7 billion of revenue in the third quarter of 2023 compared to $112 billion of revenue in the third quarter of 2022. So that's a decrease of about 20% year over year. And then for net income, we can see that increased even more from about $20 billion to about $9 billion. So that was down about 55% year over year. So obviously this is not good news really, but these earnings results are reflective of the more recent oil prices, which are closer to average oil prices. And so given the fact that this is also their second greatest year in terms of earnings, even at the lower oil prices, it could be a good sign because it means that even in a year where oil prices weren't sky high like they were in 2022, they were still able to produce revenue and earnings that were competitive to their outlier results in 2022. Now we can see their income statement for the fourth quarter and the full year of 2023. We can see for the fourth quarter, they had revenue of $84 billion. That's down 12% from $95 billion in 2022. And then they had net income of $7.6 billion, which is down 38% from about $13 billion in 2022. So again, similar to quarter three, not very impressive revenue and earnings growth for ExxonMobil. They saw pretty sharp declines in both areas. And then lastly, for the full year of 2023 compared to 2022, they had revenue of $344 billion. It's an impressive number, but not nearly as impressive as it was in 2022 when it was $413 billion. So it's down 17% year over year. And then for net income, we can see they had net income of $36 billion, which is down 35% year over year from $55 billion. If we scroll down here, we can see their balance sheet. They had total assets of $376 billion on December 31st, 2023, total liabilities of $163 billion, and then total equity of $212 billion. We can see they have retained earnings of about $453 billion, and then about $254 billion of common stock held in treasury. This basically shows how much common stock they've repurchased, and we can see that number is steadily increasing year over year, so they are continuing to return value back to shareholders. And then lastly, for their cash flow statement, they had operating cash flow of $55 billion, which is down from $76 billion year over year. And then we can see from their financing activities, they paid cash dividends out to shareholders amounting to about $15 billion in 2023. And then also they acquired about $17.7 billion of common stock in 2023. So obviously that's like $30 billion worth of value returned back to shareholders, which is more than half of their operating cash flow. And actually, if you include their additions to property, plant, and equipment, and you subtract that from operating cash flow to get their free cash flow comes out to be about $34 billion. So they basically spent almost all of their free cash flow returning that value back to shareholders. It's a pretty good sign that Exxon is able to grow their business, invest in property, plant, and equipment, and continue to increase their dividend as a result of their healthy cash flow statement. So all in all, a lot of good news for ExxonMobil, except for their obvious revenue and earnings decline. Okay, so now we can see this DCF model to try and value ExxonMobil's company. I'm using a pretty optimistic growth rate of 44% for the next 5 years. I'm basically just using the exact same growth rate that they've had for the last 5 years. As we can see right here, they had free cash flow in 2019 of $5 billion. And then in 2023, it was $33 billion. So if you do the math, that's a compounded annual growth rate of 44%. So considering those were the results for the last 5 years, for this analysis, I'm going to use those same results for the next 5 years, or same projections. Then to calculate the discount rate, I'm using a weighted average cost of capital of 6%, which I got using this calculator right here. I calculated the cost of their equity using the risk-free return added to the beta of their stock, multiplied by the average market return minus their risk-free return, which was about 9%. The interest rate on their debt was about 1.6%. So if we do the math and multiply that by the equity proportion and debt proportion of their balance sheet, it comes out to about 6% for the weighted average cost of all of Exxon's capital. We can see they have a net debt position of about $10 billion when you subtract their debt from their cash, and about 4 billion shares outstanding. Puts their intrinsic value per share at a pretty high mark, $839 per share. Basically means at the current share price, they're trading way below their estimated intrinsic value per share. So it's up to you really to decide if you believe this metric. Obviously, the DCF model uses a lot of assumptions, like projecting that for the next 5 years, their cash flows are going to grow at the same rate that they've grown over the last 5 years. Obviously, there's a lot of good news for Exxon in the way of dividend, but in terms of stock growth, they're not really a growth stock. So it'd be a little optimistic to assume that they're going to hit $800. But based on this DCF model, the growth rate that they've had over the last 5 years, then also the weighted average cost of their capital and the current cash on their balance sheet, it looks like they are currently trading at a pretty steep discount compared to their estimated intrinsic value per share. So now I wanted to compare them to some of their other competitors in the oil and gas industry, Chevron and ConocoPhillips. We can see based on this, Exxon is basically coming in second place for profit margins. First place is going to ConocoPhillips. And then it also looks like ExxonMobil pays the second highest dividend yield after, or second to Chevron. So based on this, you probably want to give it to Chevron for dividend yield and ConocoPhillips for earnings. It looks like ExxonMobil is coming in second place overall. And now I wanted to compare Exxon to some of the other companies we've looked at on this YouTube channel so far. Compared to other companies that were trading in comparison to their intrinsic value per share, Exxon comes in second. They're trading at 12% of their estimated intrinsic value. So obviously that's pretty good. We can also see the other companies on the list that were trading at a pretty good price compared to their intrinsic value per share so far that we've seen. Then right here for growth rate, Exxon comes in second place at a 44% growth rate. Not surprising, 44% is pretty high, so it's not that shocking that they're coming in second place here. Dividend yield, they're also coming in second place. This one's pretty interesting because 3M is in first place, but as we've seen from previous analysis of 3M's company, they're kind of struggling, so their dividend yield might not be as consistent as ExxonMobil's, which has increased consistently year over year for the last 41 years. So obviously this is pretty impressive for ExxonMobil. And then for gross profit, net profit, and Q3 year over year revenue and earnings growth, Exxon doesn't make it onto any of these tables because they had pretty low profit margins compared to other companies we've looked at. And as we saw earlier from their revenue and earnings growth, they had negative revenue growth of 20% and then also earnings decline of 55%. Lastly, for stock performance, we can see that over the last 5 years, Exxon is only up 37%. Keep in mind, this growth is not including the dividend return from their dividend payout, but just based on the growth, it looks like they're not good enough to get onto this table. Tesla had the highest at 850%. So let me know in the comment section down below what you guys think of Exxon. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.